Hi everyone! In this video I'll walk through how to complete a worksheet exercise through to the profit and loss statement and balance sheet. The first thing to bear in mind when looking at an exercise such as this is that it can look quite daunting with the previous year's balance sheet, a large worksheet template and a series of transactions to go through. However, as we work through this exercise, I hope you'll see that it's just a matter of walking through each step one at a time. Now, the best place to start when completing this kind of exercise is to start with the information which has already been given to you. So in this case, it's the opening balances. These opening balances are obtained from the previous year's balance sheet, as the closing balances of one period automatically become the opening balances of the next. You'll notice that in this balance sheet, over here we have the who, the what and the when. So we have the who as in the business being ABC, the what being the balance sheet, and this is also known as the statement of financial position, and the when, which is as at 30th of June 20XO, and this is our balance sheet from last year. So let's start by entering in these balances. So in our current assets we have cash. Now cash is another way of calling bank, and we have 25,600. Might help if I put it in the right column. 25,600. Accounts receivable is also known as debtors or trade receivables, and we can see that that figure is 43,600. And prepaid rates are rates which we have paid in advance but we haven't yet incurred the expense, and that amount is $4,000. Stock is also known as inventory, and we can just put that figure straight in of $84,000. Now you'll see on the worksheet that I've already included the heading for prepaid rent. We don't have an opening balance for this on last year's balance sheet, but I do know that we have a transaction relating to it coming up, and I've simply saved some time by naming this column ahead of time. Now moving on to our non-current assets. So if we look over here on our last year's balance sheet, we have non-current assets of machinery. So here we have 50,600. We also have accumulated depreciation of minus $12,000. So let me just put in minus 12,000 here. It's really important that you include the minus, as this serves to reduce the value of the asset to show a more realistic value of that asset over time. Essentially, the longer you hold an asset, the more you're going to use that asset, the less that asset is worth, and accumulated depreciation is simply our way of showing that. Now you will see that I do have some yellow boxes here on the worksheet. These are used to be able to run a quick cross-check as I go through the transactions to ensure that I'm keeping that accounting formula of assets equals liability plus owner's equity in balance. You may have noticed that this formula here at the top in my worksheet the formula here in my worksheet is up there. So I've got assets which equals liability plus owner's equity. Currently my total assets here equal 195,800, which I can do a quick cross check against last year's balance sheet to ensure that I have included everything, and there it is. Our total assets, which is our current assets, and our non-current assets equals 195,800. So far everything's going great. Now we move on to our other side of the accounting formula and the worksheet. So we need to continue entering in our opening balances. So that leaves this information here for us still to enter in. So we have accounts payable here of 33,400. And we have our accrued wages. So our accrued wages is 3,400. Then simply we continue on and look at, we don't have any non-current liabilities, so that's perfectly fine. There's nothing there to put in. We have capital of 120,000. So 120,000 goes in there. And we have our retained earnings of 39,000. So we can enter that in. So our retained earnings is simply the profit that has been accumulated over previous years. Okay, now that we've got all of those opening balances entered, let's just check those yellow boxes to ensure that this balances. So we've got 195,800 on our asset side, and then on our liability and owner's equity side, we also have 195,800. It's really important that you go through that step just to make sure that as a starting point, your balances for both of these categories match the balances that you have over on our balance sheet, and that just makes sure that you haven't got any transposition errors, so where you've typed in the wrong number. Okay, now I'm going to write the number of transactions here. So here are all the transactions that we're going to do, and they correspond to the transactions that we've got down here. So our first transaction is the owners withdrew drawings in the form of cash for $46,000. So if cash is leaving the business, then we need to reduce the bank account. So let's enter in here minus $46,000 into our bank column, and the other side of this equation looks at our capital account, okay, because drawings is a reduction of capital, so we need to subtract $46,000 there. Just as a final point, it's a great idea to complete the notes to the accounts to explain why this transaction represents. It doesn't need to be a lot, but it should be enough to explain what the transaction is about. So here I'm just going to type in drawings just as a bit of an explanation as to what it is. Okay, so we've done our first transaction. Now's a good time to check whether we're still in balance or not. So looking at our yellow boxes down here, so this was our opening position. You can see I've entered in those two transactions and we're still in balance. So things are going great. Let's look at our second transaction. So our second transaction is premises were rented out and an annual rental of $40,000. During the year, rent of $50,000 was paid to the owner of the premises. This tells us that we have paid not only the rent for the year, but also a proportion of next year's rent too. So we need to show that in our our bank account has decreased by $50,000 because that's how much we've paid out, and also that we have a prepaid portion of the rent. So let's do that. We've reducing our bank account by $50,000, and our prepaid rent here we put in $10,000 because that's the rent that we've paid for next year. Now we do need to account for the $40,000 in the expense, so for the rent that we have incurred, and so that is going to be over here as $40,000. One more. There we go. So let's just do another quick check. Yes, we are still in balance. So our third transaction is rates on the premises were paid during the year for the period 1st of April 20x1 to the 31st of March 20x2 and amounted to $6,000. So let's start with the amount we've paid. So the amount which has left the bank account is $6,000. So we need to reduce our bank account by the $6,000. So a minus figure there. Part of this amount relates to an amount which is prepaid, as we are only completing this exercise to the end of the financial year, being the 30th of June 20x1. We're told in the transaction that the year's rates are $6,000, which means that if we divide $6,000 by 12 months, then it works out to be $500 per month. With this information, we can then work out how much relates to this financial year and how much will be prepaid into next year. If we look at the 1st of April to the 30th of June, this is 1 quarter or 3 months, and 3 months at $500 per month equates to $1,500 in rates for this year, leaving $4,500 as a prepayment. So here we'll put 4,500 in our prepaid rates column. So prepaid rates, we're going to put 4,500. And don't forget that we have the rates expense for this year of 1,500, which we need to account for. So as it's an expense, it's going to go all the way over here to affect our profit and loss, or it's going to affect our profit by reducing the amount we have there. So we need to put in our 1,500. Because it's reducing our profit, it's a minus. Again, we check and we are still in balance. Now, we're not quite finished with our prepaid rents yet. So our opening balance of prepaid rent indicates that we already paid for some rent. For some of the rates. The assumption is that you will not pay for an expense until you have used up any prepaid amounts first. As we've just paid for rates, we must have already used the prepaid amount, and therefore we need to reduce the prepaid rates by the opening balance amount of 4,000. We also need to recognise that the expense has been incurred and therefore need to affect the profit account for the same amount. So over here we need to account for the fact that we've used that $4,000 in prepaid rates, so we're now reducing that, and then over in our profit and loss area we need to balance the equation and indicate that we have used that. Again, don't forget to put the commentary here. So for here I would probably put something for our first transaction here, which was rent for the year plus, and I'm going to put in 10,000 prepaid, so that tells anyone who was coming along what's actually happened there. Then here is our rates expense, and the second part of that is the use of prepaid rates from previous year. So these notes make it really clear for someone else coming along to actually see what the transactions are, because they wouldn't have the benefit of this information down here. Okay, so now let's look at transaction 4. We've got depreciation for non-current assets is 7,720. Now, depreciation is a book entry and as a result doesn't impact our bank account because we're not actually paying anything out. It does, however, affect our accumulated depreciation account and it's considered an expense. So we need to reduce our profit and loss as this is going, our profit and loss column, because this is an expense and expenses reduce the profit. So let's put that transaction in. So we need to increase our accumulated depreciation, and because it's already a negative and we're treating it as an expense, it's a minus 7,720. We also are decreasing the profit that we earn because we've got this expense for the same amount, and I'm just going to put in depreciation. Now there are a couple of additional things we need to do, as there's already been, now we need to do transaction 5. Okay, so transaction 5 is wages totaling 45,000 were paid during the year. As at the end of the year, the business still owed $2,620 of wages. So let's start by paying our employees the amount of their wages. We paid them cash of 45,000. So straight away, our bank is going to reduce by 45,000. It's an expense, so we also need to reduce our profit by 45,000. And our notes are going to be wages paid. That's fairly clear. Now we do need to look at a couple of other things. We can see that there's an opening balance of accrued wages here. and that was from last year of 3,400. And we need to account for the fact that at the end of this year, we're also going to have accrued wages. It doesn't matter which entry you put in first, as long as you do both entries. So let's look to clear off the opening balance here first. So we're going to be in this column. Earlier on this year, we would have paid for these wages, so we need to show that this has occurred by reducing our accrued wages by that opening balance. We also need to reverse the expense that we had allowed for in the profit and loss section. Okay, so in our accrued wages, just want to make sure I've got the right line. In our accrued wages, we're going to reduce that opening balance of 3,400, so that then nets down here to 0, and then we need to account for the fact that we're removing that. So we're going to add in 3,400, and that ensures that as far as the accounting formula is concerned, we've reduced the accrued wages, we've allowed for that in the profit and loss, those two net out, and we are still in balance. So our notation on here is going to be wages accrued last year and paid this year. Okay, so that one's done. Now we need to look at the accrual that we create this year. So that means we're going to increase our liability for 2,620, and also because that's an expense, we might need to subtract that from our profit. And our notation is going to be something like accrued wages incurred, whoops, but not yet paid. Okay. Now, item 6 on our list, and I'm going to scroll up just a little bit so that we can see what we have here. So for transaction 6, stock totaling 260,000 was bought on credit. The first thing we need to do here is to increase our stock. So here's our stock column, transaction 6. We're going to increase it by 260,000. And as we purchase this on credit, we also need to increase our accounts payable by the same amount, because we still owe the money, we're just going to pay for it later. And our notation would be, oops, purchase of stock. Transaction 7 is, let me just enter that there. Okay, sales on credit totaling 432,000. So we've made a whole bundle of sales, but we're going to get paid for that sometime in the future. So with our sales on credit, we need to account for the increase in our accounts receivable account. We haven't received the cash as yet, so it doesn't affect our bank account. So our accounts receivable is going to increase by 432,000, and because it's a sales and therefore revenue, it's going to increase our profit. So that's going to increase by 432,000 as well. And I'm just going to put sales on this credit. So that one's a nice, quick and easy one. Okay, transaction 8 is that we have some cash sales now, and cash is always great. So because it's cash sales, we're going to receive that money immediately into our bank account. So we need to add this into our bank and also add it into our profit. So we go to our bank and we are adding in 89,000 as money received into the bank, and then that's increasing our revenue and therefore increasing our profit. So it affects our profit and loss. And here I'll just put sales in cash. Now, transaction 9, collections from accounts receivable total $376,000. So here we have debtors or our accounts receivable customers paying us for their purchases. So this is going to increase our bank account by $376,000, but we also need to reduce the balance of our accounts receivable account because we're having people paying us off. And so that means we need to reduce the accounts receivable account by the same amount. And the notation is going to be something like maybe a receipt from debtors. Or you could put from AR, meaning accounts receivable. Our final transaction is payments to accounts payable of $212,000. So we're making a payment. This is going to reduce our bank account. So we're now paying for some of those purchases that we've made ourselves, perhaps some of the stock that we've purchased. And because our purchases were made on credit, we need to reduce our accounts payable because we owe these people less now because we've made that $212,000 payment. Oops, I need to put a minus 212,000. And my notation is going to be payment to accounts payable. So that's all of our transactions. Now we're told that stock at the end is $20,000. And let me just scroll up just a fraction more, see if I can get it to fit in our screen. So we've got stock at end is $20,000. This requires us to do a little bit of calculations to work out what was the actual cost of those sales. So we start with the value of our stock at beginning. So over here we've got a little calculation. So our stock at beginning we were told was $84,000. So let's put $84,000. Oops. Plus we made some purchases. So our purchases here we can see totaled, the only purchase transaction we have is this one here of $260. So if we add those together, our total available for sale is $344,000. So then we need to subtract the amount of stock at end. So we're told in the question just here that the stock at end is $20,000. So we need to subtract $20,000 and then now let's see what that adds up to. Okay, so this gives us a total of the cost of sales of $324,000. So remember this as we're going to need that in our profit and loss statement. So that's why, here we need to actually do a transaction. So we need to remember it because we're going to have it in our profit and loss, but we also need to make sure that we reflect that cost in our closing balances, and so that we can get our closing balance here to equate to the $20,000, which we know is the value of the stock that we have on hand. So to do this, we need to subtract this from our stock levels. So if we go here, we need to subtract $324,000 worth of stock because we've sold that. And this is then going to give us our closing balance here for our inventory, or our stock is $20,000, which matches what we're expecting it to be. The other side of the transaction is the expense associated with the stock. So this serves to reduce our profit and loss, or our profit. So we also need to subtract over here $324,000. And our notation is simply going to be cost of sales, or you could put cost of goods sold. Okay, so before moving any further, we do just need to do a quick check of those yellow boxes to make sure that they are the same. They are the $296,580. So let's build the profit and loss statement now. So let's scroll down to here. So we've got our profit and loss statement here. Now remember, our headings are really important. We need to clearly state and clearly show who, the what, and the when. So the who is our business, so in this case it's ABC. The what is the name of the statement, so in this case it's going to be our profit and loss statement. And the when is the period that this relates to. So this is going to be for the period ending 30th of June 20X1. You could also have it for the year ending as well. So when building your profit and loss statement, be sure to use clear headings to detail what each item is. So let's start with our cash and our credit sales. So by having a look at our transactions, again, we can identify how much was our cash and how much was our credit sales. So let's put these in now. So with our cash sales, these were 89,000 and our credit sales were 432,000. So if we just add up our total sales, we have total sales of 521. Now we also need to enter in our cost of goods sold. So our cost of goods sales was this last transaction or calculation that we did over here. So it says less cost of goods sold or cost of sales. So we're going to subtract 324,000. And then that will take our total sales minus our cost of sales or cost of goods sold to give us a gross profit of 197,000. We then look at all of the expense transactions. Now for rent we paid $40,000, so we need to subtract 40,000. Our rates are made up of two rate expenses, one for $1,500, which relates to the rent expense that we paid for this year, and the other one is for the $4,000 of the rent that we had accrued previously. So that's going to make 5,500. That needs to be a minus 5,500. Now we also calculated depreciation. So our depreciation was 7,720. So we need to make sure that's subtracted. And with wages, now looking at the wages transactions in our worksheet, we have 45,000 for wages for the year. We reversed the accrual that was made at the end of last year, as this is now being paid, and the 34,000 that we have there. And we also have set up a new accrual for wages incurred but not yet paid of the 2,620. So adding these together, it totals 44,220. So subtract 44,220. So let me just go through that again. So we had 45,000 of wages for the year. We then reversed the accrual that was made for last year because that's been paid off, and that was 3,400. And then we've set up a new accrual for wages that have been incurred but we haven't yet paid for. So that's 2,620. So all of that added together is 44,220. Now adding up all of those expenses mean that we have a total expenses of 97,440. So if we start with our gross profit, we then subtract the total expenses, then that's going to give us a net profit of 99,560. Okay, so now onto our balance sheet. We've almost finished this exercise. So again, here we start with the who, the what, and the when. So who is our business, so ABC. The what is the name of the statement, so in this case it's our balance sheet. And the when is for the period that this relates to. So this is going to be as at a date. Now, It's quite straightforward to build the balance sheet. Here you need to be pulling together all of the closing balances from our worksheet. So all of these closing balances here need to be pulled together with the exception of these yellow ones, which are our cross checks. So let's look to plug those in. So we have our cash. So our cash is this column here of 131,600. Our accounts receivable is this one at 99,600. Whoops. We probably need to put in the additional zeros there. Our prepaid expenses, being our rates, is 45,000. We have stock, which we're also told in our question, of 20,000. And our prepaid rent, so our prepaid rent here being 10,000. Okay, so then we also have our non-current assets. So our non-current assets are made up of these two figures here. We have our machinery, which is 50,600, and our accumulated depreciation. So that's the accumulated depreciation. Let me just scroll up, of our opening balance plus the expense of the depreciation that was incurred this year, equaling that 19,720. And remember, we do need to have it as a minus sign because it serves to reduce the value of our non-current assets. So let me just put in our total. So we've got 265,700 for the sum of our total assets. Our non-current assets we're also going to add together. So the total value of our machinery has a book value here of 30,880, which means the total amount of our assets is 296,580. You will see that this figure here does match what the total, if I scroll back up here, of our assets. So all of this is our assets, and it does equate to the amount that we are expecting it to equate to. Okay, now looking at our equity and our liabilities, just going to change this word to be, I know we can probably leave that there. Okay, so our accounts payable. So our accounts payable is this figure here. So put that in as 81,400. Our accrued expenses, which relates to wages, is 2,620. So the total amount of our liabilities in this case is $84,020. Now this is a really important part when you're doing the worksheet exercise, particularly for assignment 2 and for the exam, the capital at beginning. So we actually want you to clearly detail what the capital was at beginning, so that we can have a bit of an understanding of how the business has performed. So our capital at beginning is going to be 120,000. Now we're going to subtract from that the drawings that we made in the year. So we have drawings here of 46,000. So it's subtracting 46,000. Now our retained earnings at beginning, so again we want to know what our opening position was for our profit and loss or our retained earnings. So this is going to be 39,000 plus what was the profit or loss that we made in the year. So we know over here that we had net profit of 99,560. Now I am hoping that as soon as I click that button that this is all going to work out. So this here, let me just delete that out so that we can make sure that it works for me. So the total amount of owner's equity, so the sum of all of this information here is 212,560. Now the moment of truth, we want to make sure that the sum of our liabilities plus the sum of our owner's equity is going to equal our total assets. And yes, you can see here that it does, and it also matches the figure that we're expecting to achieve there. So now once you can see that, or once you get your balance sheet to balance, you've got a really high level of confidence that you've done everything right. Hope this helped you to understand how to complete a worksheet and then to build the profit and loss statement and the balance sheet.